When people hear the name the Fed, it often sounds like a shadowy power in the background. A group of people in a room, raising or cutting interest rates, and suddenly stock markets crash or boom, currencies move, and countries on the other side of the planet feel pain or relief.
We must address
It can
this
feel like
anomaly in the
magic
data immediately.
or like manipulation,
It impacts the
as if
entire
one
projection.
institution in one country somehow has its hand on the throat of the entire global economy. The truth is more complex. The Federal Reserve, the central bank of the United States, does not literally control the world. It cannot simply push a button and decide who succeeds and who fails everywhere. But the structure of the modern financial system is built in such a way that Fed decisions ripple across borders with incredible force. So the real question is not, how does the Fed secretly manipulate the world? The real question is, why did we build a world where the Fed's choices affect almost everyone? To understand that, you have to start with what the Fed actually is. The Federal Reserve is the central bank of the United States. Its core jobs are simple on paper: manage the supply of money and credit, keep inflation under control, promote maximum employment, maintain the stability of the financial system. It does this through a few main tools. It sets short-term interest rates that influence how expensive or cheap it is to borrow dollars. It buys and sells government bonds and other assets, changing the amount of money in the system. It acts as a lender of last resort to banks when there is a crisis, providing emergency liquidity. If the U.S. economy was small and isolated, the story would end there. The Fed's decisions would mostly affect American workers, companies, and banks. But the United States is not a small, isolated country. The US dollar is not just a national currency. It is the backbone of the global financial system. This is the first key reason the Fed seems to control the world. The dollar is used to price and trade oil, metals, food, and many other commodities. It is the main currency used in international trade invoices, even when neither buyer nor seller is American. It is the dominant reserve currency held by central banks around the world as a store of value and a tool for crisis defense. When countries trade with each other, they often settle in dollars. When companies borrow money internationally, they often borrow in dollars. When investors want safety, they often buy US Treasury bonds, which are dollar-denominated. This makes the dollar like the operating system of global finance. And the institution that controls the cost and availability of dollars at the core of that system is the Federal Reserve. Now imagine this. Somewhere in Asia, a company has borrowed billions of dollars to build factories. Somewhere in Latin America, a government has issued bonds in dollars to finance roads, schools, and hospitals. Somewhere in Europe, a bank has taken in deposits in euros but has lent out money in dollars using complex structures. None of these actors vote in American elections. None of them can walk into the Fed and argue about policy. But when the Fed raises its key interest rate, the price of dollars rises for everyone. When the Fed tightens liquidity, dollars become harder to get for everyone. When the Fed loosens, dollars flood outwards, searching for returns in every corner of the world. This is the second key reason the Fed has such power. There is a global dollar system that exists outside the borders of the United States. Economists sometimes call it the eurodollar system, even though it has nothing to do with the euro as a currency. It is a network of banks, shadow banks, and financial institutions holding and moving dollar claims around the world. A bank in London can lend dollars to a corporation in Brazil. A bank in Singapore can borrow dollars from a fund in New York and then lend them again in Indonesia. These movements never touch physical cash. They are entries in balance sheets, promises between institutions. But at the base of this pyramid, when something goes wrong, everyone looks to the same place, the Federal Reserve. During the global financial crisis of 2008, banks around the world suddenly faced a shortage of dollars. They had made long-term loans in dollars, but could no longer roll over their short-term funding. The whole global system started to freeze. In response, the Fed did something unprecedented. It opened swap lines with other major central banks. In simple terms, It lent dollars to foreign central banks, who then lent them on to their local institutions. The Fed became, for a time, the de facto central bank to the world's dollar system. During the pandemic shock in 2020, something similar happened. Markets panicked, investors sold everything, and again, there was a global scramble for dollars. The Fed stepped in with massive interventions, including expanding swap lines. Once again, it stabilized not just America, but the international financial system. This is the third key element. When crises hit, the world depends on the Fed as a source of emergency dollars. No other institution can create them at the required scale. Other central banks can print their own currencies, but that does not automatically produce dollars. If global debts and trade are dollar-based, you need actual dollars, not just local money. So the Fed has become something unique. It is legally the central bank of one country, but practically, it functions as the ultimate backstop of a global system built on that country's currency. Now add a fourth element, the US Treasury market. US government bonds are seen as the safest, most liquid financial asset in the world. Banks, pension funds, insurers, central banks, and big investors everywhere hold them. They use them as collateral for loans. They use them as benchmarks for pricing risk. When the Fed changes its policies, it directly affects yields on these bonds. When it buys them in large quantities, yields fall, and borrowing costs drop across the world. When it steps back or signals tighter policy, yields rise, and borrowing becomes more expensive. Because so many financial contracts and models are built around US Treasury rates, a move in that market spreads everywhere. Mortgage rates, corporate bonds, emerging market debt, all of them feel the pull. This is why markets obsess over every word spoken by the Fed's chair. A single sentence about future policy can move trillions of dollars in a day. Traders do not wait for the Fed to act. They try to anticipate it, creating waves of speculation and adjustment. From the outside, this looks like control. From the inside, it is often chaos. The Fed is trying to manage the US economy, but its signals are amplified by a hypersensitive global financial network. So when the Fed raises rates aggressively to fight inflation in the United States, something predictable happens. Dollars flow back into American assets, where returns are now higher. Currencies of other countries can weaken against the dollar. Governments and companies that borrowed in dollars see their debt become heavier relative to their local income. Central banks around the world may feel forced to raise their own rates just to defend their currencies and prevent capital flight. A decision made in Washington to tame domestic inflation becomes a shockwave that hits borrowers and savers in Africa, Asia, Latin America, and Europe. Those people had no vote in the decision, but they pay part of the price. This is where the language of manipulating the world comes from. It is not that the Fed sits in a dark room plotting how to hurt specific countries. It is that the architecture of the global system gives its domestic decisions enormous external consequences. There is also a political dimension. Because the dollar and US banks sit at the center of global payments, American authorities can use this as a geopolitical tool. By restricting access to the US financial system or to dollar clearing through New York, they can put heavy pressure on countries, companies, or individuals seen as hostile. Formally, this power belongs more to the US Treasury and other agencies than to the Fed, but they all operate inside the same dollar-centered universe. From the point of view of other countries, it can feel like the dollar system is a kind of invisible empire. If you depend on it for trade and finance, you must care deeply about what the Fed and other US institutions do. You may not like them, but you cannot ignore them. Now, if the Fed is so powerful, does that mean it is free to do whatever it wants? Not exactly. The Fed is constrained by its own domestic reality. If it keeps money too loose for too long, inflation can surge. If it keeps money too tight for too long, unemployment can rise and political pressure can build. Members of Congress can attack the Fed. Presidents can criticize it. The public can lose confidence. The Fed also cannot focus only on global problems. Its legal mandate is national. It is supposed to care about American employment and U.S. inflation, not the debt burden of foreign borrowers. Sometimes, when global stress threatens to bounce back into America, the Fed responds. But there is no formal duty to maintain the comfort of emerging markets. This mismatch creates tension. The world wants the Fed to think globally. U.S. law tells the Fed to act domestically. The result is an institution whose decisions have global impact, but whose accountability is mostly national. There are people who turn this into a pure conspiracy theory. They say the Fed is a secret cabal controlling everything, deliberately creating crises to buy assets cheaply or manipulating currencies to enslave nations. Reality is less dramatic and, in some ways, more worrying. The Fed is not all-powerful. It cannot prevent every recession or crash. It often makes mistakes. It did not foresee the full buildup of risk before 2008. It arguably kept policy too loose for too long at certain times, then had to slam on the brakes later. The problem is not that the Fed controls everything perfectly. The problem is that too much of the global system is wired through one institution's decisions, whether those decisions are wise or flawed. In recent years, some countries have tried to reduce this dependence. They talk about moving away from the dollar in trade. They sign agreements to settle in other currencies. They build regional financial systems and alternative payment networks. They buy more gold as a hedge. These moves are often labeled de-dollarization. They may slowly reduce the dollar's dominance at the edges, but they have not yet replaced it at the core. Why? Because the dollar still has advantages that are hard to replicate. The United States has deep and liquid capital markets. You can move large sums in and out with relatively low friction. U.S. government debt, despite its problems, is still seen as a safer asset than many alternatives. Legal protections, however imperfect, are stronger than in many other places. And history matters. Once a system is built around one standard, changing that standard takes time and coordination. For now, the world still uses the dollar for most big transactions. That means the Fed remains at the center of the storm. So what is the right way to think about its role? First, see the Fed as a powerful player in a system that we all helped build, not as a magical puppet master. The U.S. rose to economic and military dominance in the 20th century. The dollar became the main reserve currency. Banks, corporations, and governments chose to borrow and trade in that currency because it felt stable and convenient. Over decades, those choices created a world where the Fed's policy is exported everywhere. Second, understand that influence is not the same as intention. When the Fed raises interest rates, it is not usually targeting specific foreign countries. It is responding to domestic signals. But the network that carries those decisions does not care about intentions. It simply translates interest rate changes into financial reality for anyone linked to the dollar system. Third, recognize the risks of concentration. When too much power sits in one node, the whole system becomes fragile. If the Fed misjudges inflation, the mistake spreads globally. If U.S. politics create instability around debt or budgets, the shock hits the entire financial system. Fourth, see the opportunity for diversification and reform. Countries can work together to build more balanced systems, where no single central bank has such outsized impact. They can develop local capital markets, reduce unhedged foreign currency borrowing, and strengthen regional safety nets. This does not mean destroying the dollar system overnight. It means reducing its ability to cause collateral damage. Finally, at the individual level, there is a quiet lesson. You cannot control what the Fed does. You cannot stop markets from reacting to its signals. But you can control how exposed you are to sudden shifts. You can learn basic macroeconomics and understand that when money is cheap everywhere, some of the boom is artificially inflated.
And if we apply this
you can avoid taking on excessive debt when interest rates are unusually low, knowing that they can and will rise again. You can diversify your assets rather than betting everything on one type of investment that depends heavily on ultra-loose money. In other words, you cannot unplug yourself from the world the Fed influences, but you can stop acting as if nothing will ever change. Why does it feel like the Fed can manipulate the world? Because the world placed the dollar at the center of its financial life. Because banks and governments around the globe chose to build their debts and contracts on that foundation. Because U.S. markets became the largest, deepest pools of capital on Earth. And once that architecture was in place, the institution that controls the core of the dollar system naturally gained extraordinary influence. Not because of dark magic, because of structure. If humanity wants a different balance of power, it will need to redesign that structure slowly and carefully. Until then, whenever the Federal Reserve speaks, the echo will be heard not only in Washington or New York, but in every place where a loan is denominated in dollars, where a trade is priced in dollars, and where a balance sheet depends on the quiet, powerful heartbeat of the world's reserve currency.